What is market-neutral investing? Market-neutral investing is a strategy designed to reduce the impact of overall market movements on your portfolio. The idea is to structure investments so that gains or losses are not strongly affected by whether the market goes up or down. Investors often achieve this by holding both long positions and short positions, balancing exposure so that the portfolio's net market risk is close to zero. This strategy typically works best over an intermediate to long-term horizon. Why does it matter? This strategy matters because it aims to provide steady returns even in volatile or declining markets. Traditional investing usually depends on markets rising over time, but market-neutral strategies try to generate returns regardless of the broader trend. For investors, this can reduce stress and protect capital during market downturns. Market-neutral investing is also appealing for those who want to focus on the relative performance of specific investments, rather than trying to predict the direction of the entire market. However, it is usually accessed through hedge funds, specialized ETF, or professional investment platforms rather than directly by most retail investors. Here's a simple example. Imagine an investor believes company A will outperform company B over the next year. They buy shares in company A, a long position, and simultaneously sell shares in company B, a short position. If both stocks move up or down in line with the market, the gains in company A and losses in company B roughly offset market movements, so the overall portfolio is less affected by market swings. The profit comes from the difference in performance between the two companies, rather than the market as a whole. Some market-neutral strategies may also use leverage to magnify returns, though this increases risk and requires careful management. What else should you know? Market-neutral investing can be complex and often involves higher fees due to active management, trading, and short-selling costs. It is commonly used by hedge funds and experienced investors rather than retail investors. While the strategy reduces market risk, it does not eliminate other risks. Company-specific events, model errors, or execution problems can still lead to losses. Short selling carries its own risks, including the potential for unlimited losses if the price of a shorted stock rises sharply. Diversification within market-neutral strategies is still important. Spreading long and short positions across multiple sectors or assets can help reduce idiosyncratic risk and improve the chances of steady returns. Investors should have realistic expectations. Returns are generally more modest than high-risk strategies, as the goal is stability rather than outsized gains. To sum it all up, market-neutral investing seeks to minimize the effect of overall market movements by balancing long and short positions. It aims for more stable returns and reduces dependence on market direction, but it comes with complexity, specific risks, higher costs, and limited accessibility. For those with experience or access to managed funds, it can be a useful way to protect capital while pursuing relative gains over the medium to long term. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description, don't miss out.